Well, clearly we're in a very long cycle in a relatively volatile interest rate environment, but volatile in a good way, in that we've seen a big dip in interest rates, and to your point, an inverted yield curve, which is interesting because it typically is forecasted a downturn in the economy, although I don't foresee that coming for some time, at least through 2021. But it has made us reflect on how to hedge our loans and to give ourselves downside protection in the event of an interest rate increase, given that we're in a historical low interest rate environment. So it comes into play in our underwriting and our approach to the transactions that we're currently booking.
Well, I just think it's thrown a little bit of uncertainty in the market, and I think it's kind of frozen some borrowers a little bit. Spreads have widened out considerably, especially in the agency space. So I think there's a little bit of a wait and see approach, but with treasuries so low, deals are still getting done at really good all-in note rates. I think there's just a broader array of capital sources stepping into the market right now.
Look, I think the market volatility has impacted real estate investors. Currently, there's an estimated $340 billion of investor money that's sitting on the sidelines right now. They're all seeking those great opportunities, those value add that's going to get that return for them. I think the most important thing to remember is that there are three key elements that I would mention that at this time and with the market volatility and the inverted yield curve that people should be aware of. Number one is think of flexibility when you're looking for not only property types but also debt and financing opportunities. The second thing is to go outside the norm of asset classes. There was a great speaker today from Heitman that talked about different asset classes like medical office and self-storage. So think outside the box a little bit versus the mainstream asset classes. Of course, multifamily is always a good alternative as well in any economic environment. And the third thing I would say is leverage. Don't over leverage right now. It's not a good thing when an economic downturn or correction happens, because ultimately what you want is flexibility, and you want to be able to take that property, re-leverage it, maybe come down on the interest income and that sort of thing for the property. Ultimately, you want to have flexibility.